Big week in crypto. A central bank quietly bought Bitcoin. Singapore and the Bank of England moved to regulate stablecoins and tokenized government debt. US regulators are eyeing leveraged spot trading. And the market, it slammed into fear. Bitcoin hit 6-month lows. I'll explain what happened last week, why it mattered, and what smart investors should watch next. First, the Czech National Bank made a move many thought was symbolic. It built a $1 million test portfolio that includes Bitcoin, a dollar stablecoin, and a tokenized deposit. This is a pilot, not part of their official reserves, meant to teach the bank how to custody digital assets, manage keys, and handle AML and security. Why does this matter? Central banks experimenting with holding crypto means they're preparing operationally for a future where tokenized assets and cryptocurrencies aren't just fringe, they could be part of market plumbing, settlements, or even reserve-adjacent activities. That's a big cultural shift. Why central bank pilots matter. 1. Operational knowledge. 2. Policy design. 3. Market precedent. Next, regulators. Singapore's MAS said it will trial tokenized MAS bills next year and draft stablecoin laws focused on reserve backing and redemption. Meanwhile, the Bank of England launched a consultation on regulating sterling-denominated systemic stablecoins, complete with ideas for backing rules and even potential backstops. Short version, regulators want stablecoins that promise $1 to actually be backed by safe assets and to be redeemable on demand. The BOE is even thinking about limits on how much any person or business can hold in stablecoins and how much of the backing can be government bonds. In the US, the story is regulatory architecture, specifically the CFTC. Acting Chair Caroline Pham confirmed the agency's pushing to allow leveraged spot trading, that's spot crypto with margin, in coordinated talks with regulated exchanges. If approved, it could open huge new sources of retail and institutional flows into spot markets. Important leveraged spot increases liquidity, but it also raises systemic risk. Think bigger, faster liquidations. Regulators are trying to thread the needle, bring trading onto regulated venues while controlling leverage and investor protections. And the market reacted. Over the week, Bitcoin slid, briefly hitting 6-month lows and dipping below $94,000 amid risk-off sentiment. Analysts pointed to long-term holder selling and macro uncertainty as major drivers. What does that mean day to day? Sharp dips like this open opportunities but also indicate rising systemic concerns. If you're trading, be mindful of liquidity. If you're investing, focus on position sizing and the possibility of increased volatility as regulators change rules. Quick takeaways. Central bank pilots don't instantly normalize crypto, but they lower the operational barrier for future official tools or tokenized market infrastructure. 2. Stablecoin rules are coming. Expect stricter reserve and redemption rules and maybe holding limits in some jurisdictions. That'll shape how stablecoins scale. 3. Watch the US. If leveraged spot trading is allowed in a regulated form, volumes could jump and so could short-term volatility. 4. Markets are sensitive. Macro backdrop and long-term holder behavior matter, so expect continued price swings. If you want a quick rundown of each original article, check the show notes. I linked the Reuters, CoinDesk and BOE pieces so you can read them yourself. Smash the like button if this helped, subscribe for fast weekly crypto breakdowns, and drop a comment. What do you think? Are central banks warming to Bitcoin, or is this just cautious testing?